Risks involved in long-term investment. Insights from top investors. Long-term investment has often been celebrated as a prudent strategy for wealth accumulation, yet even the most seasoned investors acknowledge the inherent risks it entails. While the potential for growth over extended periods is promising, long-term investment is far from risk-free. Top investors like Warren Buffett, Ray Dalio, and Howard Marks have frequently emphasized the importance of understanding and managing these risks to safeguard capital and achieve sustainable returns. From market volatility and economic downturns to unforeseen geopolitical developments and personal biases, the challenges of long-term investing require careful navigation. One of the most critical risks associated with long-term investment is market volatility. Over extended periods, financial markets can experience significant fluctuations driven by macroeconomic factors, technological disruptions, or shifts in consumer behavior. For instance, Warren Buffett has often highlighted the importance of preparing for unexpected downturns, stressing that markets can remain irrational longer than an investor can remain solvent. Even well-diversified portfolios can be adversely affected by prolonged bear markets or sector-specific declines, underscoring the need for a robust risk management strategy. Another key concern is the impact of inflation on long-term investments. Inflation erodes the purchasing power of money, diminishing the real value of returns over time. Ray Dalio, the founder of Bridgewater Associates, has frequently emphasized the importance of hedging against inflation by diversifying across asset classes, including equities, real assets like real estate, and inflation-linked bonds. Investors who fail to account for inflation risk may find that their nominal gains are insufficient to meet their financial goals. Long-term investments are also susceptible to geopolitical and regulatory risks. Changes in government policies, trade relations, or global stability can significantly impact market performance. For instance, political instability in a key market can disrupt supply chains, erode investor confidence, and lead to capital flight. Howard Marks of Oaktree Capital has stressed the importance of understanding the broader macroeconomic and geopolitical landscape when making long-term investment decisions. Regulatory changes, such as tax reforms or new industry-specific regulations, can also alter the investment outlook for certain sectors, further complicating the risk landscape. Economic cycles pose another challenge for long-term investors. Over time, economies move through periods of expansion, peak, contraction, and recovery. Each phase has unique implications for different asset classes. For example, during a recession, equities often underperform, while bonds may become a safer haven. Investors who fail to anticipate or adapt to these cyclical shifts may face prolonged periods of underperformance. Howard Marks has repeatedly emphasized the need for a contrarian approach, suggesting that long-term investors must be prepared to buy when others are fearful and sell when others are overly optimistic. A less discussed but equally critical risk is psychological and behavioral biases. Long-term investment requires patience, discipline, and the ability to remain calm during market turbulence. However, many investors succumb to emotional decision-making driven by fear during downturns or greed during bull markets. Warren Buffett has famously advised investors to be fearful when others are greedy and greedy when others are fearful, highlighting the importance of maintaining a contrarian mindset. Behavioral biases, such as overconfidence, herd mentality, and loss aversion, can lead to poor decision-making and undermine long-term investment strategies. Another significant risk is concentration risk, which arises when an investor's portfolio is overly reliant on a single asset, sector, or region. While concentrated investments can yield substantial returns in favorable conditions, they also expose investors to heightened risks. A downturn in a specific sector, such as technology or energy, can disproportionately impact a concentrated portfolio. Diversification is often recommended as a mitigation strategy, but even diversification has its limits. Over-diversification can dilute returns and make it challenging to achieve meaningful growth. Liquidity risk is another factor that top investors consider when evaluating long-term investments. Certain assets, such as real estate, private equity, or collectibles, may take longer to sell or convert into cash, making it difficult for investors to respond to unexpected financial needs or market opportunities. Illiquid investments can also suffer from significant price discounts during periods of economic stress. Ray Dalio advocates for maintaining a balance between liquid and illiquid assets to ensure financial flexibility while pursuing long-term objectives. The evolution of technology and the rapid pace of innovation introduce disruption risk to long-term investments. Companies that dominate today may become obsolete tomorrow due to technological advancements or changing consumer preferences. For instance, the rise of renewable energy has challenged the long-term viability of traditional oil and gas companies. Investors who fail to anticipate or respond to these disruptions risk significant capital losses. Staying informed and regularly reassessing the investment thesis for individual holdings is essential to mitigating this risk. Finally, unexpected life events can disrupt even the most well-thought-out long-term investment plans. Changes in personal circumstances, such as health issues, family emergencies, or changes in career prospects, may necessitate accessing invested funds earlier than planned. This highlights the importance of maintaining an emergency fund and ensuring that long-term investments are aligned with personal financial goals and risk tolerance. In conclusion, while long-term investment offers the potential for substantial rewards, it is not without its challenges. Top investors like Warren Buffett, Ray Dalio, and Howard Marks consistently emphasize the importance of understanding and managing risks to achieve success. By diversifying portfolios, hedging against inflation, staying informed about geopolitical developments, and maintaining discipline in the face of market volatility, investors can navigate the complexities of long-term investing. Ultimately, success in long-term investment requires a combination of strategic foresight, emotional resilience, and a willingness to adapt to changing circumstances.